Cost plus pricing. The cost of the product or service plus any amount of profit. It is difficult to implement effectively. Pricing is a critical consideration, especially just for a small business. You should value your products based on beliefs held by your market. Competitors, well, competitors will challenge a small business with pricing strategies, and the cost plus pricing helps calculate what the price should actually be. So making detailed calculations for each product or service will be too difficult for a new business owner. So when you think about it, oftentimes time is the primary operational cost. Of course, the overhead expenses still exist, but you need to really understand what type of value your product is offering. And consistently, you should be looking at examining other competitors' pricing models and pricing around that area. So the pricing model is very good because you can use it as a tool to balance the customer flow with the time available. So if you want more customers to potentially come to your organization, maybe pricing it just under your other competitors can be a good strategy. Of course, building that type of strategy using data systems that generate useful and manageable information really helps out the new business owner, right? So it says here, startups should offer greater value for the money charged to build a customer base, right? And the entrepreneur, usually they determine the cost structure and then determine what profit margin is desired, and then adds that to the cost. So if you're trying to, you know that your product costs $1 to make, then you have to think about what you're willing to devote your time to in order to make. So if it's another dollar, then make it $2. Okay. The desired profit margin is often associated with how competitors price their products, including the amount of overhead of the business. A comparison effect occurs when consumers evaluate different firms' products and makes decisions based on an internal cost-benefit calculation. Also, a firm's prices may be higher, but consumers evaluate the service received and may choose to price your product based on that service. And sometimes a business may charge premium prices to project an image that are essentially valuable. Competitor pricing must be evaluated to determine the pricing strategies. And eventually, as the business grows, it may shift from a cost plus pricing strategy to a strategy that the market permits. And quantity discounts could be used if the business sells quantities that are tolerable if accepted by the market. So if you're selling maybe more strawberries, maybe if you say buy one, get one free, they may purchase that.